that have an impact on the property market. And you've given your time on a Sunday, on a nice Sunday afternoon. So I want to make sure that this is worthwhile and you've got some good takeaways from today. At the end of the session, we will actually showcase a project we are very excited about, and the whole session should not take more than an hour. We'll have obviously time for questions in the end as well. So you all know 2021 was a massive year. 2021, we've had a 25% increase in property prices in our city. That does not happen very often. Okay, I'll make that point very clear. It's only happened 3 times in the last 100 years. A 25% increase or above has only happened 3 times in the last 100 years. So it's not something that happens every 3, 5, 10 years. Okay, you might not see another one for another 10, 20, 30 years maybe. So it's an abnormal year, and those that were owning property through 2021 are all sitting on very good equity. Even if we did not have interest rate increases, sharp increases as we just have had, you would have still seen some correction, okay? But because of the rapid increase, and more particularly because of the fact that a lot of people are sitting on the sidelines, waiting for the market to bottom, if you like. So they're cashed up, they're waiting to buy, but they're like, well, if there's going to be another 1 or 2 interest rate increases, then why don't we wait until we think the market has bottomed? So there's a lot of people sitting on the sideline. When you've got fewer buyers in the market, then you're going to see property prices fall anyway, whether you see interest rate increases or not. So this 7%, Sydney is leading the pack in terms of the slight correction we've had. Sydney's prices in the last 50 years has never fallen more than 8% in 1 year. Okay, never fallen more than 8% in 1 year. So this is important to keep on the back of your mind. We are seeing 2 things happening at the moment. We're seeing inflation go through the roof, and we are seeing interest rates, rapid interest rate increases. And on the back of a 25% year, this is not abnormal. This is okay, but it's not going to be 15%, 20%, 25% as the media seems to tell you. Okay, that will not happen. So what's bucking the trend is Brisbane and Adelaide, particularly the stellar performer is Adelaide. Yesterday, the auction clearance rates, which is measured normally on a Saturday, came out, and Adelaide was again 82%, which is the same as what they were a year ago. Sydney is actually traveling reasonably consistently around that 65, 66, 67%, which is not bad, which is still healthy. People are still, this buyer still out there. Okay, what actually impacts the property market? In the news, so left side, I've got some news which are negatives for the property market. On the right side, I've got some news which are positives for the property market. This is not an exhaustive list, but just to give you some idea of some of the things that you hear in the news every day, every week, every month. So the RBA's cash rate now is 2.6. We went down to 0.1, we're at 2.6. I seriously thought that at 2.6, and I've been saying this for the last couple of months, I thought 2.6 is where we're going to stop. There is possibility that we could have perhaps another 25 basis points, and then the RBA may actually pause to see what the figures actually look like. Okay, particularly we want to look at retail sales, we want to look at GDP growth, we want to look at those numbers. US Fed, you know, they say when they sneeze in the US, we catch a cold in Australia, but also other parts of the world. Their rates are sitting here at the moment, which is again very sharp increases. They've done 1%, 75 basis points and so on to get there. US inflation is big on the news. So US inflation came out last week, 8.2%, which is down from 8.3 and which is down from 8.5, I think, in July. So it's slowly coming off. And 0.1, 0.2%, the market reacts. So the stock market was up sharply, and then the stock market was down again. So it's really, really very volatile, the stock market. And our inflation is running here. There's, we only do quarterly numbers. We don't do monthly numbers in Australia. So this number is actually expected to increase from here to year end. Talking about perhaps 7.5% by December. Answer is, we don't really know. This is a very important factor I'll talk about more on the left side here, recessionary fears in the US. There is a lot of talk about what is happening in some of these Northern Hemisphere countries, and that's gonna have a bigger impact perhaps than us having to do more increases in cash rates, okay? So we're gonna watch this very, very closely. On the right side, I'll let you read that. You all know stamp duty is gonna be scrapped, potentially will be scrapped here, and it'll be replaced by some sort of a land tax. Won't have time to go through that today. We are facing a national rental crisis, okay? This crisis can cause returns to go up, rentals to go up, therefore returns to go up, and therefore more investors coming into the market, therefore property prices going up. So this is something we've got to watch very closely, and I'll talk more about that later. This next couple of points on this, particularly our unemployment and our GDP, very important that we have a strong economy. And right now we have probably a very, very strong economy compared to just all the OECD countries. Our employment rate is traveling at 3.4, 3.5. Our GDP growth is at 0.9 in the June quarter. I think September quarter will again be pretty strong. People haven't stopped spending money. And then this factor is going to improve our GDP growth. So when people talk about recession in Australia, well, it's not going to happen. Okay, there won't be a recession here. We could have recession in the US, UK, Europe, and China is really slowing down in its growth. China's growth in the last quarter was only 0.4. We were 0.9. So it's really slowing down, but that they could have that major slowdown. I don't think we will. And this is a big factor, okay? We got a lot of people coming here. When people come here, the spending increases, the consumption increases, and that actually means your GDP will continue to increase and be healthy. So that's what's in the news. Very quickly, a few of my predictions in the past. It's not necessary that they'll be correct in the future, but I am happy that these predictions so far have come correct. So in July 2020, when it was all hell was breaking loose, and everybody was saying property prices will fall by 20 or 30%. At that time, I predicted property prices will increase by 20%. And if you want evidence of that, I wrote a paper. I wrote an article in the paper in July 2020 to actually say this. I predicted interest in July mid last year. I was predicting that interest rate will start rising in July 2022. Reserve Bank, I told all my clients, cannot be trusted. They have got it wrong. Interest rates will have to go up. The honeymoon period we've had with low interest rates, which we've never had in Australia before, 0.1, 0.2, 0.3, and mortgage rates below 2%, that will never happen, okay? That was just a pandemic-induced rate. So this was always gonna rise quicker. RBA got it wrong, and people who I've advised to fix their rates out to 4 to 5 years are all thanking me today. So we can't blindly follow the media. You need to be aware of exactly what factors drive these things. The other one is rental crisis. I've been predicting since September last year, and we're now heading below 1, and we'll talk more about that later. Last month I predicted, so there's only about 20% of the economists that were saying 25 basis point, 80% were saying we're going to have another 50 basis point in October. So I got that one right as well. Okay, very quickly on this one. Supply and demand is the most important thing that moves the needle on property prices, okay? Just like any other commodity out there, whether you're buying cars or secondhand cars, you've seen that the prices are actually now coming down. But through COVID, because there was a shortage of supply of cars, the secondhand car prices went up. The same thing applies to all commodities. It's economics 101. If there is more supply and low demand, guess what? The prices are going to go down and vice versa. The second one there, interest rate and affordability, is also extremely important. And it is one of many factors. Okay, I have got my top 7 here in some sort of order. So this is number 1, always number 1 with anything to do with prices. At the moment, like I said, people are sitting on the sideline, so the demand has gone down. Okay, so why would you go and bid in an auction right now? It's no point. Okay, now interest rate and affordability is very important, and that these are the 2 factors that are causing that. So this slide actually hasn't changed for the last probably 5 years that I've been doing these webinars and seminars. And so this is the talk at the moment, and this is also secondary, but that impacts interest rates and affordability. So interest rates are going up, which means your affordability is going down. Does that have an impact on property prices? Of course it does. Okay, so where it went down, you could borrow more money. It's going up, you got to borrow less money. This one's very important. Firstly, the regulation by APRA. APRA have a lot of levers it can pull. And APRA is a very important regulator, and they're the regulator for banks. And they can do more than the RBA actually in making sure that banks' policies are in check. And they've been moving different policies up and down. Your ability to pay buffers, your servicing buffer has gone up to 3% now. So if you borrow at 4%, you'll be assessed at 11%. At 7%. And that then also has the appetite for banks to lend is very important, and it's to some extent influenced by APRA as well. Okay, so if banks have good policies and they have lots of appetite to lend, big 4 banks in Australia have 50% of their balance sheet in actually residential mortgages. So just imagine half your balance sheet is one asset class, residential mortgages. So that's their bread and butter. They will have a lot of appetite, and you're seeing the competition already. You saw it in the last 2 years. There's enormous competition for banks to grow their mortgage book, okay, residential mortgage book. So this appetite will still be there. Economy, I've talked about. We're going to see unemployment still low when this huge influx of people are going to come over the next 12 months, 18 months, 2 years. You will see unemployment probably tick up a bit. It could go to 4, it could go to 4.2, it could go to 4.5. And that is expected when you're getting so many of skilled migration happening and other classes of visas with people coming here. Now, that is still very low, okay? So remember we were at 5, 5.2, 5.3, 5.5. So anywhere between 3.5 and 4.5 is still a low unemployment. It's almost what we call full employment right now. So you can't find people for employment. GDP, as I said, is going to continue to be strong. The other ones are very important. Government needs to keep doing what they're doing with spending. Albanese this morning in the news, spending more money on infrastructure, accelerating the infrastructure spend, which is very important and has knock-on impact on property prices. This one's very important. If you're going to have a write-off, if you're going to have lots of write-off in loans, if people don't pay their loans for 1, 2, 3 months, then it becomes a delinquent loan. And then the banks actually assess the loans and they might write it off, or they'll do what's called a mortgagee in possession sale. So when they've taken your house to do an auction and to recover their money, that is called a mortgagee in possession sale. You are going to see a few mortgagee in possession sales. Most of you might not have, if you haven't been here for more than 20 years, you may not have seen mortgagee in possession sales in our city. You're going to see some of those, okay? You're not going to see a lot of them. They're going to be very few and far between. When you have mortgagee in possession sales and nobody goes to bid and nobody buys, that's when property prices fall and fall a lot, okay? So you need a big amount of maybe 20% of people actually not being able to service their loans, and you need nobody coming in at the auctions to actually bid for property prices to fall. Those two things have to happen before people talk about 20%, 25%, 30% decrease in property values. Believe me, if those two things don't happen, so say one of these things happen, and we've got a lot more delinquencies and a lot more mortgage in possession sales out there, auctions. But if for every sale there are 5 buyers, the property price is not going to go down. Okay, I hope you understand that. So demand, supply and demand is very important, even on this factor here. And the delinquencies, in my view, is going to be very, very low. And we are not going to see the property prices fall because the demand is going to be, people are going to be looking for bargains. Okay, and they will have the appetite to buy. Global factors are becoming more and more and more important. So these factors, as I said, this slide has been there for a very long time, and COVID and the war, they've caused the issues we are having now. The recession could be an issue for us, and so on. The currency is another one that's not there. So our currency has gone down to nearly 63 cents. It's fallen quite a bit from about 73 cents to the US, but globally, all of the world is actually falling significantly against the US dollar. The US dollar is strengthening, and the other currencies are actually falling. Pound is almost at parity with the US dollar. That has never happened in the last 50 years. So these factors, why is currency important? Because if it becomes cheaper for people to buy a property in Australia, then you'll have more money coming this way for people who are investing. Okay, people will say, I'll sell my property in India, for example, and I will buy another property here because the exchange rate, it does have, it's number 7, it's not on the top, but all these factors have knock-on effect on global factors on our property market. Okay, very, very quickly, there have been, so if I show you this graph on the right, so from January 1990 to all the way to now, and now that the graph's obviously ticking up, is the second graph is showing you, this is the cash rate. This is the history of the cash rate. The cash rate average from 1990 to now is 5%. Are we anywhere near 5%? No, we're about half of that. We're 2.6. So when I say we are in a low interest rate environment, we still are in a low interest rate environment. Okay, what happened here is just a once in a lifetime thing that we're going to see a 0.1. But I want you to just bookmark these 4 increases we've had since 1990. We've had one tightening here, we've had one tightening here, we've had a long and slow tightening here, and we have had one tightening here. Now we're having the 5th one since 1990. Okay, so there's been a roller coaster there, and then this last 2 here has been COVID induced. If COVID didn't happen and you know there were inflation issues, we may still have seen interest rates sort of tick up from here. So I'm not going to dwell on this graph, but you know, I call this the honeymoon period, the last 2 years in interest rates. And this graph here is also important. This is the graph that is to do with setting fixed rates. It is based on futures rates. Now, on the left here, you see that what will happen to interest rates is we will probably, in my view, get to about 2.85, could even get to 3.1. Okay, this is possible. This is possible. But if I were the RBA, I would probably pause in the month of November and then actually review what the figures look like and see the full impact of all of the increases they've done so far before taking further action. the RBA has a tendency to overshoot the mark. They should never have gone to 0.1, for example. They should have stopped at 0.5. But now they're going to shoot the mark again. So the cash rates are set by the RBA. The fixed rates, so if you're any of you who fixed your rates, they're not set by the RBA, they're set by global markets. Okay, the financial markets actually sets it. So I was part of the committee at HSBC that set the fixed rates that we were going to use to offer to our clients for residential mortgages. Okay, so this is based on what we call the futures market. And then, so they preempt what is going to happen going forward. And you see that it's falling here. And then after about 1.5 years, then you start using what is called the interest rate swaps and other derivatives, the bond market, to do like a 4-year, 5-year fixed rates. So it's based, I won't dwell on this. This is a subject for another day, because there is a lot of science involved in actually building what we call a yield curve. But on the left here, I've highlighted this part here, which is very important. So if economies like China, UK, Europe do go into, not a recession perhaps, but real slowdown in their growth, and we could have a recession in the US, which is real, and stagflation is the other thing, and that basically says that you basically are not growing, you're just sort of treading water. So you basically pretty flat, okay? Neither growing nor going down. That's stagflation. Stagnant, basically, that's what the word is. And then this one we're gonna keep an eye on, but no longer that relevant, because we all know that unemployment is gonna, as I said, stay low. The last time we had a recession and a big fall in property prices was sort of in the early 80s. Okay, we had some issues with recession, and I can tell you unemployment at that time was close to 10%. Interest rate at that time was 17%. I paid 17% in 1980s. Okay, I paid 17% for my mortgage. In those type of situations, yes, you're gonna have issues. We are still, please, all of you just understand, we are still in a very good shape when it comes to unemployment. If you can't pay your mortgage, guess what? You can find another job. You can get a second job. You work another 20 hours a week and you'll pay your mortgage. In Australia, people pay their mortgages. Okay. So that kind of economy back in the 82, 83 is not gonna happen. So what are the banks predicting? This is where the banks are on the cash rate at the moment. Okay, sorry, slightly old graph, but about 2 months old. But there's a couple of banks here, ANZ and Westpac, which think that it's going to go up a bit more. CBA thinks there's going to be a bit of a pause, like I do, and NAB is there. So still low. Now I told you to bookmark those 4 increases. So I'll just very quickly run through those, going from bottom to up. So 1994 to August to December 94, the cash rate went up 2.75%. Very sharp increase in a short period of time. Okay, very sharp increase. What happened to house prices 1 year after the last hike? 1 year after December 94, the house prices were still slightly up by 0.3%. Okay, and so here you see that after 2 years it was up 2%. So quite a flat sort of year, a couple of years. After 5 years, it still went up. Second one was 1999 to August 2000, 1.5%. So not as big increase, but they normally did. At that time, they normally did 0.25% increases. There was always 0.25%. 0.5% never happened. And 1 year after that, they saw 14%. And you can read this. And then 2 years after, and then 5 years after, massive increase. So then 2002 to 2008, that was the long graph over a long period of time. They kept tightening, 0.25% over that period of time. House prices actually did fall 4.6 within the first year, and then up again, and then up again. Okay, so again, quite flat here, not massive increases. Like I said, we don't see 25% increases in 1 year. And then this period here, which was, again, you can see that, right? So my point here is this last 30, 40 years, what you're seeing is you're not seeing massive decreases in house prices in the first year after the hike. Okay, we haven't had the first year yet. Okay, so we have seen falls happening. You saw Sydney prices falling by 7%. So where will it be in another year's time? And that's important. And we'll talk more about that in a minute. The big story for Sydney is that you need to all be aware of what the macro drivers of property price will be in our city. Okay, this is very, very important graph for you to see. It's not mine, it's New South Wales Treasury. But we're going to have a massive population increase, 6 million by 2036 in our Sydney city, and 8 million by 2054. Of course, last 2 years has been a pause because of the pandemic, but that's why they need to accelerate the population growth. But these numbers, they're still going to work towards these numbers. That's what the government is running towards. So if somebody says in the next 10 years, the population in the northwest of Sydney is going to double, well, that is definitely what is going to happen. Okay, they're still going to be targeting this. The city will be growing. To have this type of growth, you need almost 40,000 dwellings per year. That's a lot of dwellings per year. We have really slowed down the number of dwellings over the last 2 years because of COVID. On the right here, we are going through massive transformation of our city. Even if you've been here for 1, 2, 3 years, you have seen so many tunnels are being built, so many hospitals are being built and being expanded, schools, universities, everything is getting done in this city. A new airport is being built, okay? The metro, and I mean, the list goes on. What you are seeing happening to your city, and this will continue over the next 5 to 10 years, is a major transformation that only happens twice in 100 years. Why is it all happening? We are catering for this population growth. It all starts from the top. It's the population growth. And then you start working out, okay, what do we need to cater for that population growth? Okay, we will need this type of growth in dwellings. We are nowhere near that. We're going to get a massive shortage. We already have a shortage, and we're going to get a bigger shortage. The floods in the northwest are not helping, because that means less areas are going to get zoned. So keep that on the back of your mind, because this type of spend on infrastructure, this is just transports, but this type of spend on infrastructure that is going on in our city is going to continue for the next 5 to 10 years. So why should you buy an apartment now? Okay. We have had a big gap form between apartment and house prices over the last 2 years. I'll show you that gap in a minute. This gap is going to start to close from now to 2023. So that's why this is a good time to get into the apartment space. They are due for the same kind of jump that houses have had, okay? And you can go and buy an off-the-plan apartment now for a small deposit, or if you can get a bargain compared to the market value today, this is the time to enter the market. So you can see what happened in 2021. So this is Sydney. House prices went up that much, and apartment prices only that much. So house prices actually went up nearly 33%, but apartment prices overall. So Sydney is not a one property market. In Sydney, you've got probably about 20 different property markets, and then you've got different classes of assets behaving differently. So when you blend, so when we say Sydney has been 7% down in the last 12 months, what we're actually saying is it's the median price across all property classes, across every suburb, okay? Sometimes one suburb to another suburb can behave differently. So we've seen a correction in land value, for example, in Box Hill. We've seen a correction in land value in Marsden Park. We have not seen a correction in land value in Rouse Hill. They are all neighboring suburbs, okay? It all behaves differently. We have seen apartment prices go down in the some of the inner city and North Shore suburbs, which had gone up quite a lot. It hadn't gone up. It was tracking very close to the house prices in some of those suburbs. Okay, but they have fallen, whereas apartments in Rouse Hill and Blacktown have gone up in the last 2 months. So property prices, keep in mind, they behave differently. Okay. So this is what I'm talking about. If you look here, right, 30-year graph here, on you've got houses up here and you've got apartments here. Someone actually said to me once that apartment prices don't go up at all. It's only just houses that go up. Well, you can see these graphs here. They track very, very closely together. Okay, they track very, very closely. The trajectory is always up. You're gonna get some blips. You're gonna get all this stuff happening. But this period here is the biggest gap that we've got between house prices and unit prices, and that has to actually close down. Okay, so why do I call this period the perfect storm for apartments? There's a big issue that I'm going to come to in a minute, but we are still, we are still in a low interest rate environment, and there is still high appetite for banks to lend. Both these factors are very important. If money dries up at the bank and they don't have a high appetite to lend to the more residential mortgage market, it will impact property prices. But we still have historically low interest rates. So, okay, we had a honeymoon period. We were paying 2.5%. Now we're paying 4.5%. Maybe we'll pay 5%. Still low, okay? 4.5 is probably 4.5 to 5 is probably where the mortgage rate should always be, because then we are at the target rate for the RBA for inflation is 2.5. Between 2 and 3, they say 2.5. If they're 2.5, the mortgage rate will be 4.5. Between 4.5 and 5, depending on which bank is more aggressive. Okay, 200 basis points is what the banks make on your residential mortgage variable rate. 200 basis points, 2%. Okay, so this is still low. Don't be fooled by the fact that if you base everything on the honeymoon period, I call it, 2%, 2.5% interest rate, that is not the norm. Okay, demand will continue to be strong, and then you can see, you all know there's going to be hundreds of thousands of people coming into our city, and already we have a crisis. Okay, you're going to see positively geared properties again. I mean, it was there COVID time when interest rates went down, but what's happening now is rents are going up, and rents are going to go up a lot in the next 12 months. Massive amount rents are going to go up, and I'll tell you why in a minute. Okay, and more foreigners are influencing the higher end of the market. There's a lot of foreign buying happening in the higher end of the market. Supply I want to talk about. Okay, particularly my second bullet point here is extremely, extremely important. I'll let you read the other bullet points there quickly. But this graph is probably the most important graph you will see today. So this is what the future apartment completions are going to be in the Eastern Seaboard, Melbourne, Sydney, and Brisbane. But look at Sydney, 2022, this year, 14,000 apartments are going to be completed. This is completed, okay? And this is where they are, in the outer suburbs, in the middle suburbs, inner city suburbs, city fringe, and central city. Not much happening in the central of city, but you see cranes everywhere else, okay? Lots of cranes in the northwest of Sydney, southwest of Sydney, and so on, Parramatta, etc. So the important factor is 2022, these projects actually would have started in 2019, 2020, okay? So they're getting completed this year, right? So half completed, fully completed, but now fully completed. Now 2023, 9,600, only 9,600. Why? because it takes 3 to 4 years to get a whole apartment project from start to finish. By the time you apply for a DA, by the time you start the project, by the time you complete the project, it is a long period of time. So 2020 and 2021, the constructions, there was a massive construction slowdown, and a lot of people were just worried about getting food on the table and making sure they're safe from COVID. And we had a lot of lockdowns and so on. So this is why that figure is small. But look at 2024. Look at 2024. We're only going to have 4,500 completed apartments in our city. Guess what is happening at the same time that this is happening? Guess what is happening to the demand? The demand graph is going the other way. Okay, the demand graph is going the other way. Demand is up here and supply is down here. What will happen to property prices? Okay, you're all very smart people listening to me today. This is extremely important. Nobody is talking about this at the moment, but these figures are not my figures. These figures are from the analysts, from the CoreLogic, and all the people that are doing the looking at these statistics on a daily basis. Okay, so very important graph for you to all keep on the back of your mind. When will they start talking about it? Probably late 2023. Okay, yes, 2025. The graph will probably go up again. Okay, but this combined with the gap we already have between the house prices and apartment prices is the biggest story I'm telling you today in terms of the future. The next 2 years, huge migration, and the supply is dwindling, and this, on the back of that, you've got rentals. There's no rental properties. Okay, so we'll come to rentals in a minute. Cost of construction is going up. If nothing happens, if nothing else happens, and only the construction price goes up by 20%, guess what happens? The value of properties have to go up by 20%. So we sell properties all over Australia, but in Sydney, I can tell you that all of the developers we are talking to, they're all telling us that the prices are going up. The prices have to go up. They cannot survive without pricing going up. So nothing else happens, the price of apartments are going to go up because of construction costs. Rentals we know about, heading up and up, chronic shortage. I'll talk more about that. Significant household saving. We say Australians saved $220 billion during COVID. Money was sitting in the bank. Okay. The reason why we are still spending, we're still buying new TVs, we're still buying new cars, and the government does not want you to, is because we have saved the cash and we have got money. Okay. Business confidence is high. Business confidence wouldn't be high if they weren't employing people. Everybody wants to hire more people. Thousands and thousands of IT staff are required by just the big 4 banks. They can't find them. Okay. Confidence, investment is very important. And the last one you know about talked about. So the big 4 banks are predicting 2022 national forecast to be this. I'm sure they've revised the numbers since this. 2023, they see a bigger fall. This is across all property classes, okay? And the total change they're predicting between 2022 and 2023, quite big numbers here, quite big numbers. These numbers are not going to happen. The big 4, you know what they said in 2020, they got it wrong. They will get it wrong again. This is my prediction, okay? This hasn't changed for a while, probably needs a little bit of revision, but not much. So I've broken it down into houses is blue and apartments is the beige color or the orange color. So I've got houses down 5%, but apartments up 4% in 2022. So this is just 2022, okay? This is not a 12-month thing. This is just 2022. Then I've got 23 houses going up, actually, okay? Houses going up, but apartments going up significantly more. So over the 2-year period, I've got houses down 2%, but I've got apartments up 18%. It is my prediction, and I'll live and die with it, okay? Now, very quickly on the rentals, I said I'd talk about rentals. Nationally, now we've gone below 1%. So Sydney is at 1.1. This time last year, we were at 2.5%. That's a huge drop from there to here. Adelaide is the lowest at 0.3 at chronic levels. They're followed by Perth, followed by Hobart. But, you know, in a big city like Sydney, when you've got 1.1% and heading lower, in the next 6 months, you're going to see this figure heading close to 0.5. If we get to 0.5, that is worse than chronic levels, means you cannot find a house to rent, okay? And that factor is going to drive the rentals through the roof. If you think rentals have already gone up quite a bit, well, think again. It's going to go up more in the next 12 months than it has in the last 12 months. So if you're renting an apartment at $500 and it's gone to $560, well, next year it's going to $660. Okay, people come to me and say, what's the rental return on this investment? And I say, well, at today's rent or tomorrow's rent? Today's rent is irrelevant, okay? By the time you get to middle of next year, you watch how much rentals have gone up, okay? So to make that point very, very strongly. Now, the demand for house rentals versus apartment rentals. So in Sydney, you can see that, and these are sort of 12 months to June numbers. So you can see the apartments, there's a lot more demand for apartments now than there is for houses. Well, most of the rental properties are actually apartments. Look at Melbourne. I mean, so we're gonna, any vacant properties that we have is gonna be snapped up in no time, okay? So that's very important. Now, this is the simplest graph you're gonna see today. We are getting economic growth, we are getting jobs growth, and these two things are gonna result in wages growth. It's going to happen, okay? If it hasn't happened too much, it will happen. Population growth creates increased rental and buyer demand, which causes increase in property values. Remember, I said it is not just about interest rates. The media leads you to believe that it is just about interest rates. It is not about interest rates only, okay? So I have seen property values going up when interest rates were 12%. Property prices were rising. So most important thing when you buy a property is, people say location, location, location. Very important. Location is very important. And these are the key factors when you look at location. You got to see where there's infrastructure. I have, what we've developed in Nivas is, we have a 10-point scoring table. And if anybody's listening and they want that table, I'd be more than happy to share that with you outside this meeting. We also share the cash flow document that shows your negative positively geared cash flow and what you need to do before you buy any investment property. So we will share those two with you outside this meeting, and please prompt us on that. In fact, we'll share with you anyway, if you have the details. But these three things are important. The price you pay for a property is extremely important, okay? Extremely, extremely important. We have people who bought a $950,000 apartment in Rhodes 3 years ago. And they come to me now and say, you know, everybody says I've made 20% on my property, 25, 30, 40%. People who are living in houses in Rouse Hill are saying I made 50% on my property. People living in Ponds are saying I made 60%. I did not make any money. My property is still 950,000. 3 years ago, I bought it. The price you pay. You must never overpay for a property. You must always pay a price which is at a wholesale price. That's what we specialize in. Timing is very important, and who is building your property is important. Okay, now without further ado, I'll actually hand over to my colleague Krish. Krish will talk about this project, which we are very excited about, because it ticks all these boxes. Okay, it ticks all these boxes, and we have, before Krish starts, I'll just say that We have over 30 projects in Sydney at the moment, and we are only showcasing 2 projects in Sydney at the moment, and this is one of them. And there's a reason for that, okay? We as a company will only show something that we are prepared to buy ourselves. That is a very strong ethic that we have, is if we are not going to buy something ourselves, if it does not add up for us, it does not tick all our boxes, we are not going to go near it. If we're not going to go near it, we're not going to show any of our buyers to go near it. And you will see why this is a compelling product. Krish, I'll hand over to you.
Thanks, Sachin. Thank you, everybody, for joining us today. And thank you again, Sachin, for such an insightful presentation. Now, what we are looking at in front of us, everyone, is a project called the One Waterfront in Wentworth Point. Now, this particular project, if we flick across to the next screen. Thank you. So this particular project is located in Wentworth Point, as mentioned. So it's located towards the southern end of Wentworth Point, where the cursor is at the moment. Then as you basically move your cursor up towards the northern end, well, that's Rhodes over there. So you're directly across the road from Rhodes. If you can see those tall buildings to the left-hand side of Wentworth Point, that's where I guess all of the infrastructure has been coming up. So you've got a shopping center and a few other bits and pieces, which I will get into in more detail. But if we could just move across to the next screen, that's okay. Thank you. So guys, this gives you a really good idea of where we're, I guess, from Meadowbank. So from Meadowbank, looking down towards Rhodes and Wentworth Point, where that's Rhodes where the cursor is, that's Wentworth Point. What you can see there is a bridge which is connecting Wentworth Point to Rhodes, right? So your connectivity levels over the last 5 years have improved significantly because Rhodes has a train station and Wentworth Point also has a shuttle bus, which takes you to and from Rhodes every 15 minutes. And that's a free shuttle bus as well. Now, if we just pop across to the next screen. Okay, so what we've got here is just a few of the amenities of the project. So you've got everything you need. So you've got a gym, you've got 2 tennis courts, outdoor cinema, you've got a billiard room. So it's a very, very much resort style living. So it's got a fantastic array of amenities. There's also an indoor cinema as well, which is quite cool. And there's a lot of different bits of technology as well. So state of the art intercom systems, which can control your lights and all sorts of different things in the apartments too. And one thing which I didn't mention is, guys, this project is completed. So we can go and have a look at all of the apartments and everything we need. So this is just one of the outdoor pools to give, again, that feel of resort style living. So you've got a pool inside, you've got a pool outside as well. Let's pop across to the next slide. This is just showcasing one of the sky bridges, which they have connecting the buildings in the one. So again, it's very nicely done, very well built project. And if you can see where the cursor is to the right there, that's actually Sydney Olympic Park. So you've got Olympic Park not too far away. And if we pop across to the next slide, tennis courts, guys. So as mentioned, there's an array of facilities, indoor pool as well. Then as we go to the next slide, gym, yep, next. And guys, one of the most important bits of infrastructure that's come into the suburb recently is the new shopping centre. So as you can see on those 2 images on the left-hand side, we have one of Sydney's largest Coles in there. We've got doctor surgeries, dentists, butchers, news agencies. So all of your necessities are in this shopping centre. There's an anytime fitness as well. So basically everything you need. Directly across the road from the shopping centre is a library. So this is one of Parramatta Council's largest libraries as well. Again, state of the art. That's the bridge on the right image that you see connecting Rhodes to Wentworth Point. So in terms of infrastructure, everyone, it's second to none. I mean, anywhere in Sydney, you're not going to get all this within walking distance. And there's more, which I'll mention in a minute. So there is a public school which has been completed about 2 years ago. There's a high school coming up right next to it as well, which is called the Sydney Olympic Park High School. So you've got 2 schools, which is fantastic. All the schools come with water views as well, which is quite cool. And then as you pop across to the next slide. Now, another huge bit of infrastructure which is coming in, which will most likely be funded by the government and Bill Berger, is the marina. Now, everyone, if you think about all of the suburbs across Parramatta River that have a marina, as soon as, and I'm not sure if some of you have been here long enough to see this, but as soon as the marina comes in, the price of properties there grows significantly. As soon as you can come and park a boat somewhere, the prices just grow. So this marina is been approved. It will be completed, I dare say, within the next 3 years. It's going to have a beer garden and restaurant at the top. It'll have a proper restaurant in the middle, more of your boating facilities and all that at the bottom as well. So they're converting this whole esplanade is converting to a very upmarket area, and like a sort of condensed mini version of Darling Harbour, you can kind of call it. So yeah, it's really changing in a significant way. Now, the other thing is directly across the road from the one Wentworth Point, this is where the light rail is coming in. So the station for the light rail is going to be directly across the road. They're going to be putting traffic lights there. So from the one Wentworth Point, across the road, you've got the light rail. You walk 500 meters down the road, you're at the ferry terminal. You walk 100 meters from your apartment, you connect to a shuttle bus, which is free, mind you, as I mentioned before. That takes you to Rhodes every 15 minutes, to a train station, or to IKEA, or to the cinemas. So every single thing you need is right here. And why I say right here is because I live here as well. So I'm a testament to the fact of all of this infrastructure and how good it is. So this over here, guys, so you're not going to believe it. So about a 5-minute walk from the one Wentworth Point, they're building one of Australia's largest outdoor surfing facilities. So this is going to be a wave pool with, I think it's 2-foot waves or something every couple of seconds or something crazy like that. And that's going to be open, from I think 7 in the morning until 8 at night. It's going to be heated. It's going to have, again, bars and restaurants and all that. So, I mean, where else in Sydney do you get your light rail, your ferry, your train, a man-made beach, everything within 10 minutes walk? There's nowhere in Sydney, absolutely nowhere. So then you go to the next one. Yep. So again, this is another very important thing. So we have 33 kilometers of bike tracks here. So people say, oh, Wentworth Point is it's a concrete jungle. Yes, look, to an extent, there is buildings coming up. And of course, it's turning into a major CBD and a hub in Western Sydney. But we've also got greenery right across the road. So I've got a dog and we go out there every single day and there's kilometers and kilometers of tracks and greenery and everything. So it's actually quite a good blend of both. This is just another image. So about a 5-minute walk from the one, you've actually got a promenade where you've got a cafe and you can sit right there on the bay and things like that. So it's really quite nice. Then as you pop across to the next slide. Now, this is just to give you an idea of I guess, what a high level snapshot of what is available. So in terms of, we've got 40 apartments left. Now, 1-bedroom apartments are starting from 599,000. 2-bedroom apartments are starting from 689,000, right? Just to give you a bit of an idea. And what I want to really highlight here, guys, is that just down the road, literally a 6-minute walk from the one, there's another project called the Sanctuary, which is coming up. Okay. Now that project, the Sanctuary, and we've got some prices here just to show you. Their 1-bedrooms are starting from 795. Their 2-bedrooms, which have just dropped the price, are starting from 950. They're 221s. So the discrepancy in price between us and them is almost $200,000. Now, one thing I will highlight again and go back to what Sachin was saying is that valuation issue. So what Sachin mentioned was there was a guy who bought a 1-bedroom apartment in Rhodes for 950, right? Now, this is another example of a nightmare coming true. This guy bought a 1-bedroom off the plan for 950. 2 years later, it completed, and he's trying to on sell it for 950. We had to tell him, no, it's going to be worth about 750 in the current market. Anyway, the long and short of it is, this is what's happening with the Sanctuary. Prices are through the roof. We are not confident valuations are going to stack up there at all. However, with our project, the actual prices are on market, if not below. It's a completed project, so you can do all of your strata reports, valuations, and everything to make sure you're getting the right project and at the right price. And as Sachin's got on this slide here, the developer is the Piety Group, who have been around for quite some time. They've got a huge project which they're doing, in Lane Cove, which has been done. They've got another project. I think they've bought the sorry, the Intercontinental Double Bay as well, which is being completely revamped and redone through them as well. They're a developer builder as well. So they've got, a lot of experience, and they build a very high-end product, which you can come and see because it's ready to go. And yeah, it's completed. And as Sachin's got in front here, this is another project which they're building as well. So this is in Hurstville. This is comprising of 4 different towers. So yeah, they've got a whole depth of experience, which is fantastic. Now, as I mentioned, the pricing is very aggressive too. Now, 3 bedrooms, guys. So 3 bedrooms at the Sanctuary are starting from 1.65. Our 3 bedrooms are starting from around the 1.1 mark, just to put it in perspective. So again, a huge discrepancy in price. Now, these are just some examples. I'll quickly flick through just some of the floor plans. So this is a 1-bedroom apartment floor plan. This is the one which starts from $599. If we pop across to the next slide. So this is a 2-bed, 1-bath, 1-car, which starts from $689. And guys, if you look at these prices and just go on realestate.com and Domain, these prices for a brand new unit are on par with what is selling in a 10 to 12-year-old unit, just to put it in perspective. If you look at any other suburb where there are brand new units in secondhand, there's a gap of about 30 to 50 grand in price, right? These are selling at the price of a secondhand unit. So again, as I mentioned, very aggressively priced. Now, this is a 2-bed, 2-bath, 1-car. This is for $740. And look at the layout. You've got separated bedrooms. You've got a walk-through robe. You've got island bench top in the kitchen. You've got all, nice, decent-sized balcony as well. So they're very well priced, very, very well priced, actually. And all the amenities that you need as well. This is another 221 for $745. So, guys, obviously the best and easiest way to get a gauge for what this product is to come out here. You can meet us. We can show you the project. We can take you for a walk and show you all of the different amenities as well. I've got all of them on video, so I can share them with you on WhatsApp after this if you'd like. And just pop across to the next slide.
Just the next one.
Thanks, Sachin. So this is this is just another example of an apartment as well, which we've got here on level 12. This is a 221 with an 83 internal, so again slightly bigger. So we've got different sizes, different layouts. Everything that you need, basically, we've got options for. They are selling quite quickly. There's no question about it. And one thing that I did want to mention today, guys, is that we do have an incentive for this project as well. So obviously the prices are very aggressive, but above and beyond that, the developer is also giving a $5,000 cash back as well. So bear in mind, the project is completed. So you get obviously the apartment, 6-week settlement, and then $5,000 paid to you at settlement. So, you're buying under market. You've got all the infrastructure coming up and already in place. There's quite a bit of it already in place. So look, in a nutshell, guys, it really does stack up in terms of value, in terms of infrastructure. If I drive to the city right now, it's going to take me about 25 minutes. So it's really a wonderful place to be. And look, what I'll do after this is I'll share my details. I'll share Raj's details as well. And you can get in touch with us to book an appointment to come and have a look at the project. Or if you just want to book a one-on-one with Sachin and have a chat with him and pick his brain, then we're more than happy to do that as well. I'll leave it over to Sachin. Thank you, guys.
Thanks, Krish. So a couple of concluding comments, as I always make with the end of each session. You can't blindly follow the media. You must actually, I'm sure all of you are very smart when it comes to looking at properties, and you've got your own perceptions. You've got to have a balanced view of what has happened in the past, but what may happen going forward based on all the facts. Media will always show you what sells, headlines sell. So don't follow those headlines, do your own analysis. And if not, talk to us in more detail. Okay, we are, as Chris said, we are available to have one-on-ones. We don't charge for that. We're happy to help people build a property portfolio. And it is all about a long-term view when you're building a property portfolio, because if you what I say to all my listeners is, and some of you listening today would probably have husband and wife both working, You've got good salaries, decent career path. There's no reason in the world why you can't retire on double-digit properties, right? You got to have a view that you're going to have 10 to 15 properties by the time you retire, particularly if you are, in your early 40s. So there's no reason why you can't get there. That's what we specialize in. We show you how it's done. Okay. And properties make money. If you own $10 million of properties by the time you retire, well, guess what? If property prices only go up by 5%, you make $500,000 by doing nothing. And there's a lot of people who made a lot of money doing nothing last year when property prices went up 25%. If they had a big property portfolio, a lot of people I know who have made $1 million to $2 million last year doing nothing. Okay. So this is how you generate wealth. You cannot retire on super. If you have super in the bank, you get what you're gonna get. If you have $1 million in the bank today at 2.5%, that's only $25,000. You can't retire on that, and you can't live off that. So this project, just some numbers and emails there for our company. But while you're looking at that, the reason why we showcase this project to you today is because the location is absolutely amazing. I mean, in Norwest, I live near Norwest at Kellyville, Norwest area. 2-bedroom apartments are around 900,000 in Norwest. I'm not saying Norwest is a bad area. Okay, some of them actually are over $1 million. But there you've got, from our when we assess a site and we're looking at ticking all the boxes, it ticks all our boxes. You can walk to everything. It is almost at the center of Sydney, where it's like within half an hour you get anywhere. So with so many amenities, with so much still infrastructure still coming in there at these prices, it's a no-brainer. So if you're building a portfolio, and rents are about to shoot through the roof. Already the rents have gone up close to $100 a week in that place. And it would not surprise me if it goes up another $100 a week in the next 12 months. I will leave it at that and take any questions. Okay, is there any questions in the chat?
No questions.
Write anything or feel free to ask us anything you would like.
Yeah, as I always say, guys, no such thing as a silly question, so fire away.
I just want to check, but what's the strata?
Strata, yeah, for
single
a
and two?
1, 2, and 3. Okay, 1 bedroom you're looking at about 8 to 900 for a 1 bedroom. 2 bedroom would be about around 1100 to 1200. 3 bedroom would be about 13 to 1400, roughly about there, if I'm not wrong. Yeah.
Two bedrooms are up to 1300, I think.
Yeah. Okay. And I mean, that's because, you see, when people think about strata, they say, oh, wow, that's expensive. Well, it's not when you think about it, because you've got all of the infrastructure I mentioned. You've got gym, indoor, outdoor pool. So if you're the kind of person that is going to obviously, utilize those facilities and that sort of thing, then it's an amazing place. Yeah, it's got everything.
And what's the rental expectation for 2-bedders?
2-bedroom at the moment. So there's been a huge change in the last 12 months for 2-bedders here. So for a brand new 2-bedder, you'd be looking at about $620 for a brand new to $630 a week, something around there for a brand new. Yeah.
Okay.
But it would not surprise me if it goes to 700 in the very short future. So it's gonna have to tick up from there, to be honest. But yeah, question said, it's a good question. Strata is a very good question. I have apartments, so I've got an apartment in Top Ride, and I'm paying about $1,700 a quarter, and it's got all the facilities except tennis courts and other things, but it's got quite a few facilities. This one's got, as Chris said, it's got all the facilities. You've got rooftop cinema, you've got indoor cinema, you've got pools, tennis courts, you've got everything. So in Liverpool, I've got an apartment where there's nothing. There's zero facilities. I'm still paying I think 1,050. So it's all relative when you're looking at these things. And when somebody is renting and paying you a good price, they want to see what facilities you've got, and that attracts better rentals as well.
And guys, the demographic in this suburb as well, it's probably about the maximum, the median age, I would say, would be around 30 to 40, I would say, roughly around there. So it's a very young professionals living around here. So it's a good demographic, it's safe, and yeah, it's a fantastic place to live. I was supposed to be here for 2 years, and now I'm going on 6 years out now. So it just shows you. So, all right, great.
Any other questions?
There's no questions. We'll wrap it up.